What's going on, everybody? It's Jeff here. Welcome back to the channel. Has been a bloody past 2 weeks for us. Many of our portfolios are pretty red. I've had people reaching out to me, sending us screenshots on our private community saying they're down 5%, 10%. I got guys that are down 25%. Well, in this video, I'm going to try to ease some of your fears and go over exactly what some of the catalyst behind this sell-off is. I'm going to go over why it's actually normal for the market to pull back a little bit and correct, how you can benefit from this specific pullback, and where I think it is going over the next couple of months. So stick around, you're not going to want to miss this. For those of you that are new to the channel, I started back in January after being in a bunch of different Discord chats and groups of different people, and they said, Jeff, you got to start making some content. So if you find any value, please consider subscribing, leaving a thumbs up. I truly appreciate it. So let's get into this video, guys. First off, let's take a look at the market. This is the NASDAQ index. It is pulled off of a high of about 14.1 that came in a Monday the 16th, and it reached all the way down to about 13,000. That is about a 7% pullback. A correction is classified in the market as a 10% pullback, so we're not fully there yet. We've seen some retracement on the 23rd after the Senate Banking Committee and the Federal Reserve met. Ease some of their tensions a little bit. I do believe investors didn't really fully believe exactly what Jerome Powell had said, but we're going to dive into that a little bit further. I wouldn't be surprised, even though we're upticking today by 1.6% as of now, I wouldn't be surprised by another little bit of a pullback going into early next week. So let's take a look at what exactly happened. Okay, so the Federal Reserve was meeting with the Senate Banking Committee on Tuesday. Okay, investors knew this was going to be happening, and a couple things that they were worried about was, is the Federal Reserve Chairman Jerome Powell, is he going to raise interest rates? Okay, and why are bond yields increasing? What we are going to do? Are we going to continue buying mortgage-backed securities, selling Treasury bonds, because we need to raise money? That's what the government does to be able to raise money for themselves. Okay. And we're going to dive into that a little bit. So first off, guys, interest rates have remained rock bottom, okay? It really can't go any lower, and a lot of investors are nervous about that easy money lending kind of stopping right now. Okay, that's what helps fuel the economy, especially at the time of the coronavirus. They pulled that back. However, interest rates eventually will need to rise as our national debt continues to rise as well. So investors were very nervous about that. Jerome Powell did come out saying he does not plan on raising interest rates, which was good news. Okay, however, they talked about the rising Treasury yield bond rates, and that has investors nervous as well. A part of me, considering I've been through many of these corrections and pullbacks before, I feel this time investors are like, you know what, we're not fully believing exactly what he is saying. Okay, we're going to get into everything a little bit further. So let's talk about the Treasury bonds. Okay, the government issues Treasury bonds to help raise capital to be able to provide for our nation. It's very simple. Have you ever heard the terms of, other countries are buying our debt? Well, this is one way they do that, right? So if you look at here, the 10-year Treasury yield, it's moved from 1.13 to 1.61. It's a 48 basis point raise. It's the highest level in a year. That's pretty high. Okay, so investors were nervous about that. All right, because basically what it does is the gap between the Treasury yield, the bond rates, and the gap between what dividend rates are in the market is very, very small. So investors will shift their money from the market to the Treasury to bonds, okay, when the difference isn't that much. And I'm going to dive into that in a little bit of a further, but the reason why people invest in Treasury in bonds, okay, when the yields are high, is because it's a very, very low risk. Okay, so let's take a look at just this is the S&P 500, and it has a yield of 1.48%. Now that comes because they give a $1.58 dividend per share that you have. Okay, now that $1.58 is stationary no matter what the price is. As the price goes up, your yield percentage goes down. Okay, and as the price goes down, your yield percentage goes up. When that difference is not much from bonds, investors will shift their money over to bonds because the risk is minimal to none. Okay, when there is a much larger gap, investors will say, you know what, I'm going to go after that 2.5%. I'm going to go after that 2.75%, 3%, whatever it might be, because it's much more enticing. When the difference is only 0.1, 0.2%, it's not worth the risk. Okay, so that number needs to kind of pull back a little bit, and in order for that to happen, in order for the dividend yield to rise, the stock price needs to go down. Okay, it's very, very normal for that to happen. Another thing that they were also talking about was the fear of inflation is causing investors to speculate the Federal Reserve may have to shift policy sooner than expected. Okay, now let's take a look at this chart. This is the M1 money stock, okay, it's also known as the FRED. This is pumped out by the Federal Reserve. This indication shows how much money individuals have. It's basically like a cash on hand when it comes to a business, is how I refer to it. The reason why it has spiked insanely since the coronavirus is because people are not spending, all right? You got to think families, they're not going out to eat. They're not doing entertainment and leisure. One of the biggest ones is that they're not going on vacation. For a family of four to travel, a lot of families will spend anywhere between $6,000 and $10,000 to travel, and many of them have not traveled at all. While certain individuals, such as millennials, my age, I'm 31 years old, I might have gotten away to Mexico for a few days because prices were just so, air flights were so cheap. A lot of people aren't traveling. They're not going out, okay? And money is just being held. It's not being spent. That's also another reason why the stock market has risen, is because many, retail investors such as us have had some extra cash on hand to be able to dump into the market. However, this worries investors because when the economy does reopen, okay, they're worried that the influx of money is going to be so great, okay, that inflation is going to rise, and that's not always a good sign, okay. And the reason why inflation would rise is because it's broken down basics of supply and demand, right? Right now there's very low demand. When that demand increases and goes up because people want to buy more merchandise, they want to go out, they want to go to restaurants, you're seeing people wait at the door. It's natural. Prices begin to go up, inflation begins to go up. So that is what has nerved investors, okay? Now, Jerome Powell did say he's not worried about inflation, and this is one of the biggest things that I do not believe, or that investors do not believe that he said, is that, he should be worried about inflation because they believe that it's going to be one of those snapback realities, that it's not going to be, once a vaccination gets out, once, the CDC can release some optimism of like, it's safer to go out, still wear your mask, but it's safer to go out. It's not going to be one person trickles out. It's going to be an influx of people that just hit, I would say hit the streets, but it's going to be a lot. It's going to be a big change. So that's why these investors are really worried about inflation, okay? And when that happens, that's when they tend to pull out of the market. This is also a chart showing, okay, the bond rates, the long term. The short term has decreased and the long term has increased, which causes people to shift their money. Now, when people say, "Oh, have you been through this before?" I know a lot of people that watch my channel are very new to investing. A lot of people that are in the private community, which if you haven't, it's the first link in the comments. We would love to have you over there. Okay, a lot of people have been investing for 4 weeks, 7 weeks, 10 weeks. So they haven't even been through, the September or October pullback. Well, let me tell you guys, this is very normal. Okay, you want to see the market come back 10%. You want to see it come back, 5% here and there, 10%, okay? It's very normal. If you can see, this is a nice solid curve. This is the 1-year chart, a nice solid line, upward trend. It's beautiful, and there's been some pullback. September was a good size pullback. Okay, it's normal because what happens is, in 2008, which I have been through investing 2008, and I didn't have nearly as much capital as I do now, and I lost a absolute astronomical amount of it, is because stocks began to get way away from that national moving average line, which causes in order to get back to the line, it's not a 10% drop. It's not a 15% drop. It's a 40, 50, 60% drop. That's a market crash. So if you consistently saw the market just continuously climbing and no pullbacks like this, it would worry me much, much greater. So this is very natural to happen, and don't be alarmed, okay? Because I can guarantee you that the comeback is going to be greater, just like it has been every single time in the past year. If we go over the past 5-year charts as well, it's the same thing. Pullback, bigger pullback that lasted a little bit longer, and the comeback has been even greater. Look at the coronavirus. It was a huge V-shaped, pattern return. So it's not something I would be worried about, okay? I do believe that them keeping the interest rates low, the vaccination coming out, more stimulus, and naturally people are going to go out and spending, all right? It's going to help with the market overall. Now, a couple things that you guys can do to help mitigate this in the future is, and this is one thing that I really looked at, had a little eye-opening and had to look at myself, is because focus on where you're investing. Now, in our private group, I had laid out exactly what the different sectors of the market are and how to properly diversify yourself. After this pullback and seeing where I was at, I noticed that a couple of my portfolios were a little bit too tech heavy. In the past year, I have purchased more stocks getting into the EV side. I've been in Tesla for a while, but I bought NIO, I bought Xpeng, I bought Liato. Okay, I've also bought some more technological, Nano Dimensions. Just to name a few: SPE, Blink Charging, Plug Power, so many. It was too much on the tech heavy side. And I talk about diversifying, getting over in financials, what hasn't taken that hard of a hit. Travel and leisure has seen an increase in the past 2 weeks. Okay, healthcare is going to do very well, especially with what's going on right now in our given economy. Learning to diversify yourself is going to help mitigate some of these downturns. Okay, another thing, this is the most important thing that I also tell everybody to do, is have some cash on hand. Now, personally, I like to keep 20% of my money separate and saved for into times like this, because you're buying awesome value stocks such as Apple and Tesla and Microsoft and Intel and so forth. You're buying them on sale. Have cash on hand. Okay, when the market starts to pull back, your portfolio is dropping 10-20%. I'm not worried about that extra 20% of money. Okay, let's just say $2,000 I have off to the side that I might be missing out on plays when the market is rising, because at these times of dips, that's when I can get in, get these deals, and be able to help mitigate some of these losses, dollar cost average down. It's very, very important to always have some cash on hand and never put all of your savings or all of the money that you have into stocks at the time. Okay, so very, very, very important. All right, so guys, I hope this eases a little bit of your tensions. This is not going to be a market crash. It's a natural market correction. Okay, look at some of these V cuts right here. Or I'm sorry, you can't see them, but I'm looking at it on the chart. They're absolutely great. We're going to see the market continue to roar. Guys, that's it for this video. I hope it helped you out. Please consider leaving a like, subscribing to the channel. If you are interested in joining our private community, it's the first link in the comments, and I'll see you in the next one.